As part of measures to curbing rising inflation in the country, the Monetary Policy Committee of the Central Bank of Nigeria has unanimously voted to increase the benchmark interest rate. That's the monetary policy rate to 14% from 13%, making it a second hawkish move by the Apex Bank in 2022. Let's take a listen to the governor of the Central Bank of Nigeria after the meeting where he briefed the press.
The committee clearly identified that inflationary pressure was being driven by both demand and supply side factors, which should be addressed using different policy approaches. In the committee's view, the demand side factors were being broadly addressed by the bank using the relevant direct and indirect instruments. On the supply side, the bank has continued to provide the necessary support through its development finance initiatives in the real sector to ease supply constraints. The committee called on the federal government to prioritize efforts to curb the menace of insecurity to enable farming and other business activities return to normalcy. To ensure that output still remains in focus, MPC advised the bank's management to continue to use its development finance tools to support the agricultural and manufacturing sectors in Nigeria. Committee thus voted unanimously to raise the monetary policy rate, MPR. One member voted to increase the MPR by 150 basis points, 6 members by 100 basis points, 1 member by 75 basis points, and 3 members by 50 basis points. Consequently, committee resolved to increase the MPR by 100 basis points from 13% to 14%. And in summary, MPC voted as follows. 1. Increase MPR to 14% from 13. 2. Retain the asymmetric corridor at plus 100 and minus 700 basis points around the MPR. 3. Retain the CRR at 27.5%. And 4. Retain liquidity ratio at 30%.
Well, let's get talking. And joining me live via Zoom to evaluate the impact of this development, of course, on the financial sector and the overall economy. I'm being joined by the Chief Consultant at Adedipe Associates Limited. That's Dr. Biodun Adedipe. Thank you very much for your time, Dr. Adedipe. It's good to have you on the show.
Thank you so very much, Tolu. I'm happy to be with you this afternoon. Many thanks.
Yes. At first, the last meeting, it was 150 basis points shift. That was what we saw the Monetary Policy Committee implementing. Now it's another 100 basis points. We stand at 14% from 11.5% just in a short while. Do you think this is the right way to go with what we face as a country?
Right. Thank you so very much for that. I will say immediately that yes, it is the right way to go, and for 2 major reasons. One is the fact that is what is happening all over the world by central and reserve banks in response to the inflationary pressures that we are seeing globally. So it's our own central bank, therefore, also aligning with what is happening globally. That's on the one hand, because we are not an island to ourselves. Secondly, is the major purpose of the monetary policy rate. It is a signal rate, which means whatever the central bank does with it is a strong message to the financial institutions and actors in there in terms of what the CBN expects them to do. So if, as we had it now, there is an increase, it means the signal to the banks and other financial institutions is to raise their own lending rates, which if they do, that means loans and advances become more expensive. When they become more expensive, it means that there will be a little bit of hold on liquidity that goes into the economy. And to that extent also, it will moderate the pressure that comes on the inflation rate through the liquidity from the banking system. Now, the other side to it is that when central bank does that as well, it also means ideally, banks should also increase the rate they offer on deposits and other investment instruments, which will serve also to take some liquidity out of the economy into the banking system. So that way, you are looking at the banks working as monetary policy transmission agents to help central bank curtail liquidity and ultimately, therefore, affect the ultimate target, which is inflation rate. That's the way it's supposed to work. But now we also raise an issue. The issue is the nature of our inflation, which incidentally, the central bank governor also made reference to when he was reading the communique of the outcome of the MPC meeting. Now, he made reference to the fact that the inflation in Nigeria is pushed. It is cost push on the one hand, but he also made reference to demand. But in my own estimation, the general sentiment by professional economists is that inflation rate in Nigeria is more cost push in nature, which means anything that happens and affects the cost of doing business ultimately filters through into the selling prices of commodities. And that ultimately also affects the consumer price index that is used to compute the rate of inflation. So in which case, the worry more is about whatever policies we make, how that affects the cost of doing business, and therefore ultimately affects the general price level.
Let's take it up from assessing some of the interventions of the monetary side. A lot of talks around the CBN intervening the pharmaceutical space, the creative space. Agriculture is well known, the Anchor Borrower scheme and all of this. But in your assessment, with all of the research and all that you do, Dr. Adedipe, what's your assessment of the impact of all of this? Because that's also what can help achieve inclusive growth. And if we are not growing as an economy, whatever is done, not having a level or a stable production base, will definitely have a challenge. So what do you make of that, the intervention?
Yeah, excellent. Now, we've had different arguments from different stakeholders of our economy. Some claim that the intervention by central bank is not something the bank should do. It is not part of its mandate, which I don't agree with. Some of us feel that the central bank has a responsibility for development of the economy. And that brings me to something here. This happened about 20 years ago. I was invited as a speaker at the annual monetary policy conference of the Central Bank of Nigeria. And I recall before I started addressing that gathering, I asked the then central bank governor, and that is Babas, Joseph Sanusi. I asked him and said, if the Nigerian economy works, President Obasanjo was the sitting president then, he will take the credit. And if the economy did not work, you are the sitting central bank governor of Nigeria. At the moment, sir, you will take the blame. I said, I needed him to agree with me on that before I would make my presentation, which was about monetary, macroeconomic stability. And the old man smiled and nodded. So I said, okay, fine. So which means anytime the economy is not working, the central bank governor takes the blame. So if that is the case as a principle globally, it then means that the central bank has a responsibility for the economy and not just the financial system. Because the financial system, like I said earlier on, is only a mechanism through which central bank can transmit its policy to the larger economy. So if that is the case, it means whatever central bank can do to intervene in that economy, the real sector now, is in order, especially in a desperate situation Nigeria is, where the growth we have been experiencing since the recession of 2016 has been fragile. That has been an argument. So we needed central bank to intervene, which for me, rightly, it has done. What we should actually be interrogating is look at those various intervention schemes, look at the outcomes, and then ask ourselves whether the outcomes are in line with the expectations we set at the beginning. If there is a variance or let me call it a disconnect between the actual we are seeing today and the outcomes expected, that means something went wrong somewhere. So what went wrong? What do we need to correct? Which is essentially, what I do for a living, asking the question, what needs to change? So if you look at all of this, one thing that stands out, and I think the Monetary Policy Committee also, admitted that in the communique, and that's the fact that security is a major issue for us in Nigeria today. So all the interventions, yes, in the right direction, as far as I'm concerned, but the key thing is that the maximum value promised by those intervention schemes, Nigeria has not been able to extract from them because of constraints coming from security, coming from logistics, and of course, the issue of markets themselves. And that is why I said earlier that the monetary policy rate is a signaling rate. Now, the signal means CBN wants to cool the economy. That is, ensure that inflation rate, comes to stabilize and probably ultimately also start coming down. So if that is the case, it means the signal has gone to all economic agents, not just the banks, but those who borrow from the banks, whether companies or individuals who do now consumer borrowing, banks call it consumer lending. Now, all of these people that borrow from the banking system certainly would have taken this information in. And that also means they go back to the drawing board and see how this plays out in their projections for the second half of the year. So if that means in this instance, yes, the interventions are in the right direction, quite all right. But what do we need to change there and improve for us to get maximum value from them?
The IMF and the World Bank have also come up to say Nigeria's response to the same inflationary pressure, which is a global issue, some of which we cannot control. Clearly, looking at like the Russian-Ukraine war, energy crisis, that is a global one. They've come to say Nigeria's response has not been too commendable, tardy in their word, saying that more needs to be done. So if you are to advise government now, particularly as we move towards an election year, many believe that the fiscal side might be a little bit relaxed and politicking might be just the focus. What can help us scale through this time with all of these challenges, Dr. Adedipe?
Yeah, thank you so very much. I think the first thing we need to ask ourselves at this point, like I said earlier, what needs to change? That means focus is on reforms. What do we need to reform? Unfortunately, the perspective of the World Bank and IMF, and that is where I don't always agree with them, is to look at finance. And we always hear them put a lot of emphasis on the exchange value of the naira and always look at what that rate goes for at the roadside compared to the official rate. Now, on their own part, especially when you look at the Nigerian development update that the World Bank usually issues every half year. If you look at the latest one, they admitted and agreed that yes, Nigeria has made some progress in terms of some reforms. In fact, the last one, they commended Central Bank for now aligning the official rate with the rate at the investor exporter window. So which is quite fine and commendable. Yes, we have done that. But they keep referring to the premium, which is the difference between the official rate now, which is I&E window rate, and the roadside rate. But that is where, in my own estimation, they actually miss it because that is academic. Academic because what is triggering the movement of exchange rate in the parallel market is nothing to do with fundamentals of economics, in my understanding here. It is more to do with what you might call the vagaries of the environment where we live in. And now one of them is this is a pre-election year, as you mentioned earlier on, okay? A pre-election year, we know that the parties will have their primaries. They also start preparing for the general election. There are some state elections also holding within this year. Now, we know the pattern with our politics. Maybe until we depart from money politics, that is when we would see the impact of that on the exchange value of the naira, okay? That is on the one side. Now, equally, there are seasons of the year. For example, as we speak now, if you go to the FX market, every segment, especially the parallel market, they will tell you that even ordinary $10,000, $12,000, they cannot supply until people return from Hajj. I mean, this came out of, you made reference to research. This came out of surveys that I did only yesterday, okay? Not long ago, only yesterday, to know what the state of the market is. So the reality is that the exchange rate, the exchange value of the naira moves with such development. In fact, that report by the World Bank, they also admitted that the exchange value of the naira improves usually towards the end of the year, especially during Christmas festivities, when many Nigerians come back home. And of course, we see a lot of foreign currencies move around in the market. So we know that some of these are episodic in nature, and therefore they must be isolated when we are doing our analysis. Which is why, for me, therefore, the central bank has done what it could so far, all right? And don't forget also, it is part of their mandate. Every central bank, every reserve bank, anywhere in the world, has a responsibility to protect the value of the currency of that country. Which is why I also don't agree with people who clearly say that central bank is defending the naira. What else should they do? That's what central bank should do, to protect the naira. In which case, inflation is important to them. Then exchange value of the naira is also important to them. And of course, you now come to interest rates, which is the cost of money. All right? So all of these are within the purview of the central bank. So what should we do then? It's mostly in the area of security. And then, of course, continuing reform of our commitment to infrastructure. Infrastructure is an enabler. Yes, this government has done quite well for my own evaluation. We look at rail today, it's not exactly the same from 6 years ago. We look at the roads today, they are not exactly the way they were 6 years ago. So even the ports, all right? So right now, we are almost at the threshold of the commissioning of the Lekki Deep Sea Port, which will make Nigeria number 3 in Africa in terms of capacity to handle port logistics, all right? So now all of these are steps in the right direction at the national and sub-national level. So the real missing link there, and that is what is creating the negative narrative about our country, and that is security. So, and that of course comes to the Commander-in-Chief of the Armed Forces. If, in my own estimation as an analyst, he gives an instruction today, I believe very strongly from the record of our military people, when they go for international engagement, they have the capacity to be able to handle these challenges. So if they get the mandate and instruction, and I'm happy the president did that, early this week, so that if they have that, all they need is a period of time and supply of whatever they require to take care of the security challenges you are facing. If we resolve that, a lot of the interventions and what we are doing will also improve. The other side to it, I must mention, is our fiscal operations. And that is, instead of government now looking for money either by way of borrowing or increasing, taxes and the rest of it, wanting to implement infrastructure projects, what they should do is properly design those projects and get private partners that can deliver them. We get cost efficiency there, we get quality improvement, and a lot of other benefits of public-private partnership. If we do it that way, then most of the infrastructure that are commercial in nature will get delivered, not from the fiscal space that is very tight right now, but from what private partners will bring on the table. So that is what I think we need to also reform. Infrastructure delivery through PPP is an issue we should look at. That will reduce the pressure, the fiscal pressure on the government. But that's a major issue there. So for us to have a balance then, we must ensure we align our monetary policy with fiscal policy and of course our commercial policy. If we truly want to make this economy work, there are certain things we must introduce as policies that will deliberately encourage domestic production, as the central bank governor mentioned in the communique read yesterday, and then also whatever it is we can produce here. We have no business importing them, and there are countries we can learn from. And that is where I want to leave this particular aspect, okay? India, at some point in its history, said we have capacity to produce textiles. And so if we cannot clothe ourselves as Indians, then let us all go naked, all right? But in the course of time, India became a power, player in the textile industry globally. Same thing they did with respect to automobiles, all right? They started with bicycles. If we cannot make vehicles for ourselves, let's all ride bicycles. From bicycles, they went to tricycles, and from there to automobiles. Even military vehicles now, they are dominant in that market globally. So we must be very clear in terms of ensuring we align our policies and we are all pulling in the same direction.
It's a good way to leave it there. I've been speaking interestingly, of course, issues surrounding the economy, and I've been on to Dr. Biodun Adedipe there. Thank you so much for spending your time with us this afternoon. We really do appreciate this, making sense of the figures from the MPC. Chief Consultant B. Adedipe Associates Limited. Do enjoy the rest of your day.
Thank you very much for having me.